Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day. Today's stock is going to be the IWM. That is an ETF that tracks the Russell 2000 index. Today we'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest.
And I'm Callie Cox, Senior Investment Strategist at Ally Invest.
All right, Callie. Well, I have the chart of the S&P 500 index. We've talked a lot about just the fact that we struggled a little bit breaking to a new high this time around, but we've been very strong specifically in the S&P 500 index. And finally, the NASDAQ stocks have been helping out a little bit. And we're going to talk a little bit about the Russell chart today, the IWM, which is the ETF that goes along with the Russell 2000 index. But I do want to point out one thing on the chart. We finally got the moving averages lined back up again. We have the 200-day here in yellow. Then we have the 50-day in red, and we have the 20-day in green. And if you go back and you just look at this long bull market that we had, or bullish trend, I should say, going almost a year back in time, all the way back to the breakout from the pandemic, they've always stayed in line. And the 50-day has really acted as a lot of support for the S&P 500 index. So they actually call this a golden cross. It usually, I think that it means a little bit more when you're talking about the 200-day moving average and having the slower moving averages crossing through the 200-day. But it is worth mentioning, we got the moving averages to line up again, and in general, that's a sign of a good market. Broke through a new high, and if you see here, Callie, we got a lot of green bars, and we have a big meeting tomorrow with the Fed, so a lot going on. And with that said, what are you looking at in the markets this week?
Yeah, Brian. Well, it's a busy, busy week. But before I get into that, I want to tell all of our viewers. So the opposite, fun fact here, the opposite of a golden cross is actually a death cross. And it's when a longer moving average crosses, a shorter moving average crosses below a longer moving average. So anyway, golden cross, death cross, really fun to talk about. One of those technical terms thrown out there. And it has a foil. It has its own opposite, evil twin, I guess. Anyway, it's a busy, busy week, Brian. I won't go too far down that road. Stocks, like Brian said, are back near record highs, but there might be some possible obstacles on the calendar. We have the Fed meeting this week, like Brian said, with a policy announcement tomorrow afternoon. That's the good stuff. And this one could be especially impactful because it could include some possible details or a formal announcement of tapering, or both. Now, the market is expecting tapering on the whole. That's not a big surprise these days, but it hasn't heard the details of tapering yet, and the details matter a lot, Brian. The market wants to see if the Fed can taper and keep the economy under control at the same time. And so far, so good. But this is why the details matter, okay? If the Fed's tapering is quicker than the market expects, which is always possible, we don't know what's going to happen, then we could see some yield tantrums and stock market indigestion, especially around the announcement and during Powell's press conference. And there's also an assumption out there that the Fed could start hiking rates right after the taper ends. That seems to be one of those big fears on the market's list. So if the Fed guides toward an end of tapering date tomorrow, either directly or indirectly through some language that's tough to kind of parse through, it's possible that we could see anxiety start pricing into that expected end date because the market's assumption, again, is tapering ends, rate hikes begin. We'll add to, there's no reason to fear rate hikes. Typically, the beginning of a rate hike tightening cycle isn't a big deal for the stock market, but the market could always take it that way. We're also getting the October jobs report on Friday. And this is kind of on the market's back burner, honestly. But if it's especially strong or weak, it could flare up some tensions, especially right after the Fed, when tensions are generally a little bit higher. And we're in the thick of earnings season, one that's been surprisingly good for how contentious Wall Street was expecting it to be. Fun fact, the S&P is up about 6% since its earnings season kickoff. So investors like what they're hearing. They don't seem to be worried about the future for now. Plus, the market seems to be past this whole supply chain narrative and all over the growth narrative once again. Stocks like small caps, transports, and semiconductors are popping off and flirting with record highs a little bit. But I'm going to hold off on that topic for now because I've got a lot of good insights on that later. So, Brian, in a nutshell, that's what I'm watching. Tell us what you're seeing in the VIX.
All right, Callie. So I have my VIX watch list up, and right now we see the S&P 500 index up 12 points, just 0.25%. The market has really seemed muted, waiting for that Fed meeting and the comments tomorrow overall. Yesterday, we actually saw the VIX run up a little bit on a flat market, and I think that was a little bit of an indication that there is some nervousness around this meeting, and rightfully so. So we see that trading right around 16%. Now, if I just run over to the VIX chart just for a little bit, we see that that's the lower end of the range. So even though we have seen a little bit of a spike up going into this meeting, we're still at the lower end of the range as far as the year is concerned, trading right around that 16% level. Now, if we go out to November, this is the November futures contracts that expires about in the middle of November. We see that trading around 18%. And one thing that's kind of nice is we're actually seeing that December contract come down towards that 20% level. Now, this still means to me there's a little bit of angst in the marketplace going into the end of the year because we do see the December futures up above 20, and 20% seems to be that magic line in the sand between high volatility and low volatility. And then going out to February, we also see the implied volatility a little bit higher. Now, why might this be? You can venture a guess, but we still have debt ceiling issues, and I still think the marketplace is thinking about those. We've kicked the can down the road, so that's kind of helped out a little bit with the near-term implied volatility, but we have a little bit higher implied volatility going out to the new year, January around 22%, February around 23%. So there are still some concerns, as mentioned, as Callie mentioned, in the marketplace, which makes sense. You know, inflation is a dirty word that a lot of people keep saying over and over again, and those type of concerns. But we should learn a lot about what the Fed is looking to do tomorrow. The comment period is very highly anticipated to hear exactly what their forecast is going to be going into the end of the year. I think they're going to be very trepidatious with their comments, as they usually are, but it will be one worth listening to. Now, with that said, we're going to talk about the IWM, and I want to highlight, because we are talking about volatility, the IWM it does have a volatility index. It doesn't get quoted on a lot of platforms, or it just does 4 or 5 days, but it's disseminated by the Chicago Board Option Exchange. So if you run to the Chicago Board Option Exchange site, you will see the Russell 2000 Volatility Index. And you'll see that we're also in the lower end of the range, which makes sense. But kind of interesting in that the vol has kind of spiked up here just recently. And we're going to highlight the fact that the Russell is at all-time highs. So with that said, that's just a little bit of a segue that as we get into the option strategy that I want to talk about. But not that long ago, the Russell 2000 volatility, which once again, this is a 30-day implied volatility, much like the VIX, was around 31% implied volatility and hung up around that 30 range for quite some time. All right, so that's a little foreshadowing as we get into the option strategy. But let's talk about the small caps in general. Callie, let's start by looking at the chart, and then I'll get your comments and feedback on the Russell or on the small caps in general. Now, this chart is interesting. Okay, I'm going to start by highlighting a long-term trend, and we did break through that. Now, this goes all the way back to the big downturn caused by the pandemic. And I'm going to grab it, move it up just a little bit. You can see all I did is the swing out method, where you just click on the lowest point, you swing until you hit some other points. This was really strong trend line and provided a lot of support to the Russell up until it didn't. All the way up here, it looks like we had our first breakdown. We We had a little bit of a breakdown, but that just hung there for a day. But then this was a fairly strong breakdown. And then eventually it just broke through that trend line. But good news today is we did actually set a new high in the Russell 2000 index. That high was set today at 234.54, and that happened this morning. Market is kind of dancing around this, and you see this channel that we've had highlighted in the Russell 2000 index for quite some time. Actually, didn't even have to redraw this for today's show. It's just this is about a 25-point wide channel, so big channel. We just haven't been able to break higher in it, and obviously that would be a good sign. Then you also have this trend line right here, which adds a little bit of nervousness if we do break out, that this might be a little bit of resistance for the upside overall. I still think that channel is fairly, or that trend line is fairly important at this point in time. But I'm getting a little bit long-winded. Very interesting chart. Obviously, we had the 200-day, the 50-day, and the 20-day all right here providing a bunch of support for the Russell 2000 index. But now, this is probably the biggest wild card of all the indexes. Right now, we've got a defined channel, but the Russell 2000, because of the nature of the beast, all these small cap indexes, is obviously a little bit of a harder one to tame overall as far as charting is concerned. So I like to call it the wild card of the indexes overall. This is one of the most defined patterns I've seen in the Russell 2000 index in quite some time. So with that said, let's talk small caps, Callie. Back to you.
Yeah, let's talk small caps, Brian, because honestly, you're right. We need to talk small caps. It's obvious on the chart, but looking at the fundamentals too, it's a pretty strong case. So small caps, Brian showed you the chart. They've been in a little bit of a breakout, and they did touch a 52-week high earlier today, although they are a little down. I just checked. But small caps look like they have a lot of drive behind them, even though things might be panning out their way today. The broken supply chain narrative, like I said, seems to be behind us, at least from the market's perspective. And investors generally are feeling more confident about growth expectations for 2022. Remember, earlier in the year, growth was the big worry. That was the big story. Inflation was picking up. Where is the growth going to come from? And now it seems like we're past that phase. And I'll mention, too, that inflation seems to be less of a worry, at least from an operating conditions perspective. And I know Tiara Douglas is already in the chat talking about inflation and how it hasn't been transitory. And she's right. Inflation seems to be sticking around. It seems to be consistent. But businesses seem to be digesting it very well, and they're able to pass along these higher prices to consumers easily, at least from what we've seen in earnings season. Wage growth has also been strong too, and while that can lead to stickier inflation, it also leads to bigger wallets for certain consumers, so they can handle those price increases. So it's kind of a complex situation these days, but from the market's perspective, we're kind of moving past that. And it could be, the Fed's on the move too. It could be partially because the Fed seems to be eyeing tapering and they might announce something tomorrow. And again, partially because earnings are so strong. So anyway, the market is moving into a different stage, and we think this stage could be pretty constructive for small caps. I'll mention too that yesterday was kind of a historic day for small caps versus larger caps versus their larger counterparts. Yes, the Russell 2000 actually outperformed the S&P by 2.5 percentage points yesterday, which was one of the largest spreads of outperformance that we've seen since over the past decade. I think it was about the 9th largest. I point that out just to say that typically, small caps were the star of the show yesterday. And typically when we see an outperformance that big, it shows that small caps are maybe on the edge of a breakout, either up or down. We could see some moves. So Brian, this could be an interesting opportunity for options traders. But I want to add too, it's hard to ignore these days, but the meme stocks, the AMCs and the GameStops of the world are some of the biggest weights in small cap indexes. So you have to take that into consideration. Small cap's fate could depend on meme stocks futures. So Brian, I think we should look at IWM. That's the iShares Russell 2000 ETF. It's one of the largest and most liquid small cap ETFs on the market. there could be a chance to jump in if we indeed get that breakout to the upside. So, Brian, I want to hear what you have for us there. But before I pass it over to you, I want to remind all of our viewers to please, please, please drop your questions in the chat, because Brian and I are going to be answering your questions live at the end of the show. We love that part. It's our favorite part of the show. So, Brian, show us the trade.
All right. So I'm just going to highlight inside the Ally Invest platform to start with. We do have the top 5 holdings, and I did want to highlight that for you. And it shows you that AMC is the largest holding in the IWM overall. Callie had mentioned that, and I just wanted to show you that inside the Ally Invest platform. And then with that said, here's the Russell 2000 index. So we hit an all-time high at one point in time. It's fairly important that we actually close above that level as far as the chart is concerned. Right now we're at 233.90, just basically flat on the day, down about 6 cents. Talked about volatility. Volatility is on the lower end of the range, but as we've crept up in the Russell, we've actually crept up in implied volatility. Now, I like the fact, using the strategy that we're going to use today, that we're in the lower end of the range. That is a nice thing to be if you're buying option contracts. And what we're going to look at today is buying a long call. We're going to go a little bit out of the money. This is a fear of missing out. Now, with this said, we taped stock play of the day on Tuesday. And normally when we tape the stock play of the day, always the markets are open and they're rocking and rolling. We have a big day tomorrow. So if I were thinking about this trade, I might wait till tomorrow, see what happens after the Fed speaks and see what happens to the marketplace just overall. Or you could say, well, I want to get in ahead of the game. And one way that I would approach that is a long call spread. Long call just in general, saying that I do think that we will break out, set a new high, and continue on up in the Russell 2000 index. Now, we're right at a precipice. This is a very important spot. The fact that we touched the new high and have came back off makes you a little bit nervous about the marketplace overall. So we're going to look at a long call, and that's going to be the official paper trade. And as always, it's not meant to be a recommendation overall. I do want to highlight, though, that if there is major news, a lot of people might just want to wait, even though it's on paper, for the major news event to happen. Now, a different approach would be, well, let's just assume something's going to happen. The range in the chart is about a 25-point range from the low end of the channel to the high end of the channel. That's about a 10% move overall in the Russell 2000 index. Fairly strong move from low end to high end over the last 6 months in the Russell 2000 index. So implied volatilities are a little lower. This is a little bit more speculative, but you might want to think about buying a call and a put right here, right at this very important part on the chart. Another strategy could be that I don't know where it's going to go, but I do think it's going to go somewhere. And that would be a long straddle. Okay, so the official paper trade will be the long call, but consider a long straddle. And it's mainly because we're taping on Tuesday as opposed to taping on Wednesday after the Fed speaks. That's that simple. All right. We don't choose the day we tape the stock play of the day. It's always on Tuesdays overall. So with that said, here's the Russell 2000 index. Here's the chart. If I'm buying premium, I always want to err to the side of going out too far in time, right? I don't necessarily, especially if I'm buying out of the money calls, I don't always stay all the way to the expiration. We're going to look at this expiration date going all the way out to, let me see. Oh, come on, I got to scroll down. There we go. All the way out to December 17th, 45 days out. That's the expiration that we're going to talk about. We'll probably be out of the trade within 2 weeks, but we're going to err to buying a little bit more time. Vol's down, premium's a little bit cheap relative to what it was just a couple of months ago in the IWM. So that's what we're going to be looking at. So let me get rid of this expiration. We're going to go all the way out to December. And we do know that that channel from high to low, and I actually wrote it down over here, is 25 points. So the high end of the channel is where the market is at right now. 233. Low end is around 208. So that's about 25 points. Not saying that that's what's going to happen if it breaks out to the upside or to the downside, but it's always helpful to see, well, what has the stock moved while it was trying to fight to get out of this channel overall. So I'm going to go up a little bit in price. Okay, we're at 233. If we look at the 240, it's mainly just managing risk by what I'm willing to pay for that call. So we're on the call side of the chain here. That's trading for $3.66. Implied volatility is around 18% on that. Not a bad implied volatility relative. And you're paying $3.65. That means that's the maximum you could lose if you buy one option contract is $365. Now, real tight markets, which Callie has mentioned the liquidity already. So let's make this the official paper trade, and I'll put this in the right rail. Let me scroll down here a little bit. Quite simply, we're going to buy an out of the money call, and we're not buying an out of the money call for pure speculation purposes. We're just buying an out of the money call to try to manage risk. If we go in the money and we are incorrect on our forecast, we have more risk. We're going to have to pay more for it. So fear of missing out type of trade ahead of the Fed meeting. Russell 2000 index having a very strong day yesterday, setting a new high today. Will it break out? Will it not? Simple way to do it. Manage your risk by going out further in time. Now, one thing about this is we got 45 days. So if we are incorrect and the market does go down, you still might have some premium left, right? After a week, after a couple of weeks, if this gets cut in half, I'm just going to sell it and get out, right? In other words, if I see this thing trading for about $2 or so, 175, I'm going to think about just getting out of that trade right in that range. Lose 50% on the upside, hopefully try to make 100% on the upside 50% on the downside, cut my losses, trying to make 100% or more on the upside. That would be my goal. That would just be my plan if I put this trade on overall. Okay, so now it's going in the right rail. The official paper trade for the week, not meant to be a recommendation overall, but that's the concept. And that's what the stock play of the day is all about. Just talking about, let's look at the options playbook and let's try to pick a strategy that applies to our forecast, our outlook to the marketplace, where implied volatility is at, et cetera, et cetera. Okay. Now, if you were to do a long straddle, I would just basically go the same route. I would look at buying, we're looking at buying about seven points out of the money on the call side. If we're going to do this and just tie in the put, I don't mind buying at the money as far as the long straddle is concerned. And I might do a little bit shorter time period overall. But just to make things simple, we're going to turn this into a long strangle, which means we're going to buy 2 out of the money option contracts. Now, once again, I'm just showing you this just to get some ideas in your head. Straddle means you're at the money. And if I'm going to go on 2 at the money option contracts, I might do a little bit shorter expiration. But in this instance, we're going to go a little bit longer. So I don't mind making it a strangle and going a little bit further out, since we're going a little bit further out in time. So let me remove this right rail. And we're going to go scroll down. We're about 7 points out of the money. That's about $3. It'll be a little bit more expensive on the put side, though, just because of the nature of the beast. Markets have a tendency to go down a little faster than they go up. Let's keep it $4. Let's look at the 225. All right. And this will be the one that we are buying. Now, notice we're paying higher volatility on the put side. And that's normally the case with indexes. This is an ETF that tracks that index overall. So the total cost now goes up to $760. And that's my concern. Usually on stock play of the day, we don't talk about something where you're buying $7.60 worth of premium. That means our total risk is $760 overall, but it's a strategy you might want to consider. So that's why we just brought it up. So a lot to talk about. Very interesting chart in the Russell 2000 index for the first time in a long time. Well, if you go back, we came up and bumped against that high end of the trend line actually a couple of times. And a lot of times it made a strong move back to the downside or to the middle of the channel, which that's at least a 14, 15 point move. And if you go all the way down to the bottom of the channel, that was a 25 point move. So With that said, I'm sure we got a lot of questions, Callie. What's going on in that chat box?
Yeah, Brian. Well, we don't have any questions, believe it or not, but we do have some chatting. So I'll go through that. First of all, I want to say hi to everybody in the chat box. Thank you for joining us. Apologies, my voice kind of gave out of me there. But Altitude Trader is out here saying, "Hey, Brian, love you on OPP Radio." So you've got a little fan there. Metalis2 says uranium stocks, and then he dropped a bull emoji. So sounds like he's feeling pretty good about uranium stocks. Tiara with a few thoughts in here. Tiara Douglas. Hi, Tiara. Tiara is looking at IWM for trading volatility premium, which is really interesting. Not a bad strategy. And then we have longtime caller Wayne. Hey, Wayne, always good to see you. He says, no questions for me today. So, Brian, I think we did a really good job of explaining this. And I'll give a shout out to Evan, too. Evan says, another great idea, but I'm hoping the EWC, which is, I think it's the iShares Canadian ETF, Canadian stock market ETF. He's hoping EWC sees a little bit of weakness, too. So, Brian, I'll throw you a question. So, obviously, this is a shorter term play. But if we wanted to go a little longer term on small caps, what are you thinking? Move the same trade a little further out or rethink the trade entirely?
Well, if you want to go a little bit longer term, it's not a bad idea to just actually buy the IWM. It is a little bit of an expensive index. You don't always have to buy 100 shares of everything overall, but it's not a bad idea to just be buying the IWM overall. Now, with that said, I would obviously wait before I made a longer term type strategy. But IWM has a lot of liquidity. So we've talked about this before with some of the ETFs that are out there that are very liquid, going out longer in time and actually buying a deeper in the money call option, something that acts a lot like the stock. And we've done that on a lot of stock play of the day strategies. In this instance, we just have a lot of volatility that can be created by the announcement tomorrow and what exactly is going to happen. Obviously, supply chain concerns have hurt the small caps overall. Those are waning a little bit, and we see a little bit of a pop. But I don't mind buying the stock outright, maybe selling a call after this big event. Try to bring in some income to help pay for it. That would be a covered call strategy, or just going out further in time, going out 6-7 months. Going a little bit deeper in the money, looking for something that has a little bit higher delta, showing you that it's going to act a lot more like the stock, and then just buying that option contract overall. That's not a bad strategy to go along with it. And in general, I like the concept of buying deeper in the money options as a substitute for these liquid ETFs, mainly because they usually have pretty good markets overall on deeper in the money option contracts. And when I say pretty good markets, I'm saying relative to stocks in general. Stocks in general that aren't as liquid as the actual ETFs have a tendency to have a little bit wider bid-ask spreads overall.
Gotcha. Well, Brian, I actually have a question for that. So Parth Bareel, hi Parth, sorry if I mispronounced that. Parth actually has a question about deeper in the money contracts. So Parth asks, hi, what is the downside of buying that deeper in the money call? It will cost more, but will it be intrinsic value that'll come back to us?
Well, yes. So if I buy, it does cost more. So let's say let's go 10 points in the money. All right. I don't know exactly what that would be if we bought like a January or February option contract of next year. But if I go that deep in the money and the stock comes down 5 points, well, I still have 5 points of intrinsic value. So I have 5 points of real value. And one of the big benefits of buying an in the money option contract and being incorrect on your forecast. So I buy an in the money call option. I'm hoping the market will go up. The market comes back down, is that the option contract actually goes up, picks up delta, picks up acceleration as I'm correct on my forecast. And as I'm incorrect, if the market starts coming back down towards my strike, it actually slows down a little bit on the downside, all the way to the point where it becomes an at the money option contract. Now, why is that? Well, it usually picks up time premium. At the money options have the most juice, if you will, in the option contracts, and that juice protects you. It's the most heavily traded options usually are the at the money option contracts, and you have this. Is it going to go back in? Is it going to go out? Where is it going to be? That factor is a big thing in the options trading world. So if I go deeper in the money and I am incorrect in my forecast and the market starts going against me, it slows down. The loss in the option contract slows down, as opposed to if I'm correct on my forecast and the market goes up. Now, that being said, I always have to, just to make compliance happy overall, that also means that if I'm trading an out of the money option contract, the exact opposite is true, right? So as it goes down, I get further and further out of the money. Well, it doesn't, that there's no benefit to that whatsoever. And that's that's one of the hardest things about buying out of the money option contracts, is understanding that concept. And actually, I have that in my top 10 mistakes article inside the Ally community, or the Ally blog, if you will. The most popular article that I've ever written is the top 10 mistakes that option traders make, and specifically beginning option traders, because they only buy out of the money options. I'm not saying there's not a point in time for that. As we mentioned today, I think this is a time where you would consider buying out of the money options to manage risk, but continuing to do that and not considering deep in the money options contracts is a concern overall. You really need to understand that dynamic of option pricing. And another section I could point to in the playbook would actually be the section on the Greeks, on Delta, on Gamma. And that little section inside the playbook, which we showed you earlier, optionsplaybook.com, covers these concepts very well.
Yeah, good answer, Brian. All right, so I know it's 12:38. Gave you guys a few extra minutes because we started late. Sorry about that. But let's go ahead and take things out. So I want to remind everybody that Brian revisits these trades at the end of the week, every week, on his Stock Play of the Day Overtime show. It's at 12 p.m. Eastern, right here on Ally's YouTube channel. And we'll see how things are going. And, if things aren't going great, maybe we'll adjust the trade, based on what the market's doing. So, Brian, excited for that.
Yes. So click subscribe, ring the bell, but don't go away just yet. We have an all-day digital conference tomorrow that you might want to register for. Both Callie and I will be participating in that. It's very simple. Okay, got a pen? You ready for this? ally.com/digital conference. All one word. And I have a feeling Callie might be putting that in the chat box right now. All right. ally.com/digital conference. You'll learn more about our digital conference overall, including the title, all the different events. And if you register, we'll send you a reminder to let you know that tomorrow at 11 a.m. Eastern time, we'll be kicking off an all-day event. Thanks for stopping in today. And at the very least, I hope to see you this Friday for the Stock Play of the Day Overtime.